let's talk about banks. You probably think banks work like this. You deposit money, they lend it out, right? Wrong. That's a big fat myth. The truth is, banks create money out of thin air. Yeah, you heard that right. When a bank gives you a loan, it doesn't pull money from a vault or your neighbor's savings account. It literally creates new money and credits it to your account. Boom, money created. This is possible because banks aren't really limited by the amount of money people deposit. They're limited by their capital requirements and the central bank's monetary policy. Think of it like this. The central bank sets the rules of the game, and banks play within those rules to create money through lending. So next time you walk into a bank, remember, they're not just holding your money, they're creating it. Wild, right? Stick around because it gets even crazier when we talk about government spending. You won't believe how interconnected everything is. Alright, let's talk about the government's role in all of this. It's a topic that often gets misunderstood. Just like banks don't need your deposits to make loans, they create money through lending. Similarly, governments don't need to collect taxes before they spend. Mind blown, right? This is a crucial point to grasp. You see, governments with their own currency, like the US with the dollar, have a unique power. They control the money supply. They can literally create money by simply spending it into existence. This is often referred to as fiat money. Need to build a bridge? The government can fund it. Fund education? No problem. They have the resources. The government just credits the accounts of the companies and people involved. It's a seamless process. Now, I know what you're thinking. Listen, doesn't that cause inflation? Well, it can, but it's more nuanced. But it's not as simple as more money equals higher prices. There are other variables at play. Inflation is a complex issue influenced by many factors, including supply and demand, production costs, and global events. The key takeaway here is that governments don't operate like households. They have different financial mechanisms. They don't have to balance their budgets in the same way. They have more flexibility. They have the power to spend first and collect taxes later. This allows for more dynamic economic management. This is a fundamental difference between how we understand personal finance and how modern economies actually function. It's a paradigm shift in thinking. Now, let's dive into the deep end with modern monetary theory, or MMT. MMT is a way of looking at economics that challenges a lot of conventional wisdom. It's like the rebellious cousin of traditional economics, shaking things up and asking tough questions. One of the big names in MMT is economist Bill Mitchell. He argues that MMT provides a more accurate framework for understanding modern economies than traditional or new Keynesian economics. MMT emphasizes the government's unique ability to create and manage its own currency. It argues that governments should focus on using their spending power to achieve full employment and price stability, rather than obsessing over arbitrary budget deficits. So, what's wrong with new Keynesian economics, according to MMT proponents? Let's dive into the key criticisms. Well, they argue that it's based on three false premises that fundamentally misunderstand economic realities. First, new Keynesians believe that government deficits crowd out private investment, reducing economic growth. MMT argues that this isn't true in a country that issues its own currency. As such, a country can always meet its debt obligations. Second, new Keynesians worry that government spending will inevitably lead to hyperinflation, destabilizing the economy. MMT counters that inflation is more complex and that government spending can actually be used strategically to control it rather than cause it. Finally, new Keynesians believe that central banks should be independent of government to ensure unbiased monetary policy. MMT argues that this creates a conflict of interest and that fiscal and monetary policy should be coordinated to achieve better economic outcomes. MMT argues that these flawed assumptions lead to policies that prioritize austerity and deficit reduction over full employment and social welfare, which are crucial for a healthy economy. It's like trying to fit a square peg into a round hole. the policies just don't match the reality of modern economies, leading to ineffective and often harmful economic strategies.